What's going on, guys? Welcome to the very first video on the Theta Club YouTube channel. In this video, I'm going to be going over my strategy that I'm going to be using in attempts to try and grow a very small portfolio size of just $3,100 into hopefully a seven-figure size portfolio. Also, I want to make one thing very clear that I'm not just going to be turning the $3,000 attempting to turn the $3,000 into seven figures. I will be adding money into the portfolio along the way. So I'll be giving myself from the day before Halloween in 2020 until Halloween in 2025 in order to make this happen. So it'll be kind of like a challenge in order to see what we can really do. I just want to prove to everyone that, you don't need a super large portfolio size in order to generate yourself some consistent passive income. I'm starting with just $3,000, and I think I'll be able to, just even start making money with just this. So I'll be going over my strategy, being fully transparent, showing you every single trade, whether I make money or lose money. And if you want to open yourself up a Robinhood portfolio, make sure you check the link in the description. If you do open up one now, you can get a free stock by using that link. And then if you want to go ahead and send it over to some of your friends, every friend that you get to open one, you'll get a free stock and they'll get a free stock as well. I think that stock could be valued up to about $200, I want to say, or so. So without further ado, let me get you guys acquainted with my strategy. Also, I want to make something clear too, that everything that I'm showing you guys and throughout all my videos are just for entertainment purposes only. So make sure you're doing your own due diligence and coming up with your own strategies and making your own investment decisions. Just be aware of the amount that you could lose with every single trade that you make, really. So instead of being the one buying options, the ones buying the calls and puts, I like to be the one to be on the other end and be the one to sell them. So when you say, if I wanted to buy a put for TNA, which is the triple leveraged Russell 2000, the premiums are really high, so I would have to be paying this $183 if I wanted to open up just one contract for TNA, and if I was buying a put, I would be betting on it going down. So for me, I wanted to be on the other end of it and be the one selling the puts. So in order to do this, you have to have the amount in collateral to be able to buy 100 shares of TNA, say at this $30 strike price, which is what I did. This option contract expires a week from today, next Friday. So at the $30 strike price, I had to have $3,000 in the account. If I was to sell this contract right now, I would immediately receive this $184 right now. When I opened it this morning, I didn't receive actually that much. I believe it was about $130, I want to say. But as you go down, the strike price gets lower, and then the premium amount gets lower. So you're basically bearing less risk with a lower strike price, being the one selling the put. So you'll get less premium in return for that. So at the $25 strike price, you would get $55. So you might be wondering, how do you lose money with this strategy? So the way I would lose money, say if TNA closed by next Friday below this $30 strike price, say if it closed at the $28 strike price, I would be assigned to have to buy 100 shares at $30 while the market price is currently at $28. So I would right away be down $200. But no matter what, I don't have to get rid of this premium. So this $1.90, multiply that times 100, it's $190. I keep that no matter what, whether, the stock price goes up or down. I get the premium. So that's what I really like about being the one selling puts and calls. No matter what, you're keeping the premium, which gets debited into your account right away. The other piece of my strategy, what I would do if I got assigned the 100 shares of TNA at the $30 strike price, you could either just turn around, and if you want to get out, you could sell them right away, but I wouldn't mind holding the 100 shares just because I'm pretty confident in the U.S. markets that they will consistently rise. Maybe not right away, but, over the course of a certain period of time. So I wouldn't mind holding them, which is why I like to play something like TNA, because I'm confident that it'll eventually go up. Something else you do then is, that I would like to do as well, is sell a covered call. So you're basically collecting a premium amount to sell your shares at a specific strike price. So say if I really wanted to get out of TNA at $34 per share and I had 100 shares at that $34 or at that $30 strike price, I could sell this covered call and receive immediately $167. And then if it jumps above and if it goes to, say, $36, I would be forced to sell at the $34 strike price. No matter what, I keep my premium money, and then I would also get the capital gains of going from $30 to $34. So you could add in another $400 on top of all that, which would be great. And that's the whole premise behind my strategy. A lot of people have been teaching this on YouTube, but I think a lot of people haven't been really explaining it really to the best of their ability. I really hope that this was very clear. I could definitely answer you guys some questions down in the comments. And another thing, say you have a larger size portfolio, you could also be playing something like TQQ, which is triple leveraged as well, so higher premiums, but you got to also understand that there's higher risk associated with these higher premiums, as many of you know. But for the people who are new out there, maybe you don't want to start with something that's triple leveraged right away just because you might not be used to all of the volatility. These prices do fluctuate, very quickly, and especially with the way the markets have been going right now, there's been a lot of price fluctuation. But if your account size is around the $10,000 mark, you could play something like TQQ, and say if you want to bear a little bit less risk, you could go all the way down to the $100 strike price and sell a put for, and you would get the $350. And as long as it doesn't reach that strike price, the $100, by next Friday, you'll receive all of your collateral back, so the $10,000 that you had to put up in case that the share price was below that, and no matter what, you keep your $350. So that is the main gist behind my strategy that I'm just going to be replicating in the future. I'll be showing you guys what I'm doing week by week. Even if there's a day in the week where I open up a new trade, I'll be making videos on every single one that I do just to show you guys full transparency. I'm not only going to be making videos when I make money on them, I'll be showing you guys when I lose too, because of course that does happen. As much as people like to not admit it, in order to sell you something, everyone loses money in the market. It's a part of playing this game, and I'm hoping over the long run I could outperform the market and generate some great consistent weekly income. So that's all that I have for you guys today. If you have any questions, I'll be more than willing to answer them down in the comments. And also, if you do decide to open up a Robinhood account, let me know what stock you got in the comments below. Other than that, guys, I hope you have a great rest of your day. Make sure you like and subscribe and join me on this journey. All right, goodbye.